Fellas, you know Degree Cool Rush deodorant, right? Well, last year they changed the formula, and guys were mad about it. One dude even started a petition. So guess what? Degree heard us, admitted they messed up, and brought the original Cool Rush scent back exactly how it was. And it's in Walmart, Target, and other stores now for under $4. So grab some and remember why its cool, crisp, and fresh scent made it the #1 men's antiperspirant for the last decade. Degree Cool Rush is back, and it smells like victory for all of us.
Reality radio for a really great future. We're talking real money.
Well, it's Friday, so it must be another Q&A day here on Talking Real Money. I'm Don McDonald. Glad you could join us for another podcast, and we are going to try and get some of your questions answered as we continue to get a lot of them called in to 855-935-TALK or sent in at talkingrealmoney.com, either typed or spoken. And on the Friday edition, we do the spoken versions either through the phone or through the Talking Real Money speak section. Unless, of course, we run out, which we haven't done. So we've got a bunch of questions for you today, and we hope that if you have a question, you give us a call at 855-935-TALK anytime, 24 hours a day, 7 days a week, or again, send them in at talkingrealmoney.com. And let's get started with our first question.
Hey guys, I'm a new listener in the last 6 months or so. This is Otis in Chicago, and I love your non-alarmist, nuts and bolts investment advice and your bad jokes, so thank you for both. I did score a 76 on your risk quiz, and I'm embarrassed to say I have always relied solely on my teacher pension, and I only started saving in my Roth beginning at age 50. I'm now 52. I'm retiring in 6 years. As an Illinois teacher, I will not qualify for Social Security. Due to extra coaching in clubs, however, over my career, I will end up with a six-figure pension. I still have a $225,000 mortgage, no credit card debt, and 2 kids in college. The plan right now is to never use my Roth money, but as a beginning investor, I need just a bit more detailed guidance to invest it properly. For instance, when you suggest we add small cap value, this is a super broad term, and there are so many options under this umbrella. At this time, I am with Fidelity, and I am keeping it simple with Paul Merriman's 2 funds for life strategy. So when I'm trying to add small cap value fund to my target date fund, FIHFX, do I want small cap value ETFs or only a small cap value indexed mutual fund? I know you both love Vanguard, but I do need help with Fidelity. Question number 1, do I only use ETFs in a taxable account and index mutual funds in my Roth? Question number 2, when I'm specifically comparing IJS with FISVX, I have no idea what measurement to use to decide between these 2 funds for my Roth. Tom has often stated that expense ratio is not enough information to make a decision. Where do I go next? Is turnover ratio a significant factor? Efficiency? 1-year market return? Question number 3, regarding my 2-fund Roth, how do I know if I want a target date plus a small cap value or a total U.S. stock market plus a total international stock market fund? I'm overwhelmed, but I don't want you to give me the fish. I want to know how to fish.
Oh my gosh, there's a lot of stuff there. All right, I'm going to try to teach you how to fish. But I remember we have a limited amount of time. We're gonna start. Let's start with question 1, which is basically, what do you do with this Roth portfolio? You've got. I love the idea of just keeping it simple. I just don't think we need to make it too complicated. Have a nice target date fund. Use what Paul suggests in his new book, We're Talking Millions, which is a target date fund and a small cap value. And there's a reason. There are not that many small cap values. It's not that broad a category. It really isn't. Vanguard has a small cap value fund. Fidelity has a small cap value fund, both of which are index funds. And you know about the small cap value. You mentioned it, which is FISVX, the Fidelity Small Cap Value Index. And that takes me back over to question 2, which is the iShares S&P 600 small cap versus the Fidelity Small Cap Value Index. There's a huge difference between them. There are many huge differences. First one, expense ratio. That's one of the more important things to look at. And the expense ratio on the Fidelity is lower than the expense ratio on the iShares fund by about a third. In addition, here's another thing you need to look at. You need to look at diversification. The iShares fund has 600 stocks in it. The Fidelity fund has, I believe, about 1,500 stocks. So those are 2 really important factors to consider. That is what would lead me to the Fidelity Small Value Index along with the Target Date Fund. And I think, again, back to simple. Use a Target Date Fund that's aggressive enough for your risk tolerance, which is high. So maybe you go out to 2050 for your Target Date Fund. But yes, you could go with the Fidelity U.S. total market and the international total market. But now that gives you 3 funds to manage instead of 2. And then at some point, you're going to want to add a bond fund in there for stability. So that takes you to 4 funds instead of 2. And I don't know that there's going to be a heck of a big difference between just 2 funds and eventually those 4 funds. So keep it simple. And then, see, the key is keep it simple, live your life. Don't think too much about investing. It shouldn't be that complicated. Thanks so much for the call. We appreciate it. 855-935-TALK is our phone number, 855-935-8255. And let's do this call.
Hey, Tom. Hey, Don. My wife and I are invested with a fee-only fiduciary advisor, and we've asked that they take a look at the accounts, our 401k accounts, and advise us on the funds that are available to us, what would be the best options for us and what allocations. And they've said that they can't do that or won't do that. And my question is that a typical industry practice, or should we be looking for a different advisor?
You know, they have done good advisory work for us for the accounts under their management, but they are hesitant and have not been willing to take a look at our 401k plans, the options that are available to us, and offer us guidance on what we should be doing within those accounts. And we're paying them 1% a year plus a retainer fee because we don't meet their minimum for assets under management. So we're paying them quite a bit, basically $85 a month plus 1% of assets under management, which is just under $500,000. So I feel like we're paying for the advice that they should give it to us, but would love a different perspective. Thanks a lot.
Oh, come on. Really? They won't advise you on your 401k? That's a cop-out, in my opinion. I can't think of a single legal reason why they can't do that. No, there is none. They just don't want to do it because they're not getting paid for it. And this picky Annie sort of thing that they're doing, you got $500,000 and they're charging you 1% plus $85 every month? This is an advisor I'd probably fire. I'd start hunting for a new one. Any advisor worth his or her salt is going to want to advise you on your 401k, even though they don't get paid for it. There's a good reason for that. I think it's a version of malpractice to not figure the 401k into a portfolio plan, because there may be asset classes that you can't get in your 401k, and better investments you can use there that are lower priced than some of the others so that you can build the portfolio properly. It should be a holistic approach to your portfolio. For example, you may not have small cap value, emerging markets, a lot of the more esoteric segments of the market available in a 401k. That's pretty normal. So what you could do is you could get your large cap growth, maybe some large cap value, or maybe it's just large cap growth and international that you get in your 401k, or maybe they have great bonds and you use the 401k for that. And then you build outside of the 401k those asset classes into the total portfolio. I just think that's irresponsible. I really do. I would ask them what their reasoning is. Nah, I wouldn't. We know what their ultimate reasoning is. They're not getting paid for it. It's not that hard of additional work. It's not like they're placing trades, but it should be part of the whole process. I disagree, and I think it's irresponsible. Thanks so much for your call. And the number is 855-935-TALK, or you can send questions in at talkingrealmoney.com. Up next, this call.
Hi, I grew up and bought many homes in California, and most recently, the last 30 years, owned a house in a beautiful town called Half Moon Bay. And over the 30 years, my house barely appreciated to the cost of living index. So I did not keep up with inflation. I was a little below it. So when people look at the investment for a house, California really accelerated, but it did not grow as much in most all areas as much growth as cost of living, inflation and all. So I thought your listeners would appreciate that. I would love to hear if there's a different perspective on that. I talked to many economists, and no one can give me a good reason on why I have to pay capital gains on something when my money stayed relatively flat over 30 years.
Thank you. Thank you for making a point that needs to be made. We hear so much about housing appreciation in San Francisco in the Bay Area, in Los Angeles, in Seattle, in Phoenix, in Miami, in New York. We hear a lot about those markets when they're hot, and they've been hot lately. But we don't hear about the markets that have languished throughout the last couple of decades, maybe longer. As you say, like way Northern California, or there are a lot of the eastern part of California, some of the valley areas, the Midwest, the plains. You haven't seen housing prices rise in those areas the way you have in other markets, which means that big increase we've seen in real estate, that 20-some-odd% increase we've seen this year, most of that is due to 30 and 40 and 50% increases in other parts of the market. So a lot of the country isn't seeing this. You know, I bought a house in a small town that has hardly seen real estate inflation. Homes, the same beautiful home in the town I'm moving to in Virginia, I hope, is half the price per square foot of similar houses in Florida. Probably a third the price per square foot of a similar house in the Seattle area. Probably a quarter of the price per square foot as a similar house in the San Francisco Bay Area. So, most of the country hasn't made a lot of money off of real estate. And you're right, you are paying the government, if you sell your house, capital gains based in large part on inflation. But the good news is, if the house is a primary residence, every 2 years you get up to $500,000 per couple in a capital gains tax exclusion. Life's not fair. It's not always fair. But you do make a valuable point that real estate is not the moneymaker that so many of these late-night infomercials and self-serving podcasts and people like Robert Kiyosaki would lead you to believe. Real estate is not a moneymaker everywhere in the country. As a matter of fact, it's not a nonstop moneymaker anywhere. And it makes sense that it shouldn't make much money over inflation because it is an investment. It's a commodity. It's a thing that doesn't become more valuable in and of itself unless you fix a piece of property up, unless you add to its value. It's not like a company that can become more valuable through doing a better job and selling more product. It's not like a bond that makes money because it's paying interest. Because they're borrowing money from you and there's risk. Real estate is a place to live, a place to work, a place to buy things, but shouldn't always be an appreciation vehicle, much over and above inflation. Thanks so much for your call. We appreciate it. And let's go here now. 855-935-TALK is our phone number.
Okay, quick question on 401k plan limits. It says max salary deferral for workers is $19,500. Catch-up contributions for 50 and older, $6,500. But then it says total contribution limit is $58,000 plus an additional $1,000. I don't understand how you get to that. How can you have a max of $19,500 and a catch-up of $6,500 and get to $58,000? I don't understand. Please explain. Thank you.
I could see why you're confused. It is a bit confusing. Let me explain it. All right, $19,500, that's the 401k contribution limit for everybody up to 50. Over 50, you can add $6,500 to that, making it $26,000. That money can go into either a tax deductible, let me say that again, tax deductible 401k or a Roth 401k. So you get a tax advantage at the beginning or at the end with one of those. The additional $32,000 that you can add up to the limit of a 401k, and by the way, that includes your employer contribution, that money can only go into a non-tax advantaged account. You don't get a deduction for that extra $32,000. You can't put it into a Roth 401k. All it's going to do is grow tax deferred, which is probably not that big a benefit. Tax deferral, when we're talking about paying income tax at the end, tax deferral is not a big deal. Tax deferral is a very small deal because for most people, a large percentage, if not most of their assets in a retirement plan are going to be in appreciating assets like stocks. Well, the good news about owning an index fund or individual stocks, well, we don't like you owning individual stocks, but the nice thing about owning stocks is that except for the dividends on which you pay income tax, you don't pay taxes on gains that are not yet realized. So if you have a mutual fund that doesn't realize a lot of capital gains, a tax-managed fund or an index fund, and you hold that for 20 years, well, you're going to get a lot of tax deferral. And at the end of that 20 years, when you pay taxes on it, you'll pay taxes at the current capital gains tax rate, which currently is dramatically lower than the income tax rate. So there's not a lot of advantage to going to that $58,000 in the 401k plan because you don't get any big tax break out of it. Thanks again for calling. Actually, you went in through Talking Real Money and recorded it using the microphone button, which you can do. Just go to talkingrealmoney.com and leave your question. You can type it there too, or you can call it in 24 hours a day, 7 days a week to 855-935-TALK. And if you got one of these things that just doesn't, a lot of people say, I don't have enough time to ask my question. Well, that may be because it's really complicated. And if it's super complicated, you have a lot of assets that you want someone to look over, or you're trying to determine how to best create a plan for the future, we have, and hopefully always will, at least as long as Tom and I are around, offer anyone a free meeting with one of our fiduciary advisors, no cost, no obligation, and it's not a sales pitch. It's not a high-pressure sales pitch. It's a real meeting where you're going to get some real meat out of it. A meeting with meat. What a concept. To set one of those up, just go to vestory.com, VESTORY.com, and set up an appointment right there on the front page, and somebody will get in touch with you, and we'll set up a meeting, and you'll get your questions answered. And if you want to become a client, we would love to have you, but we're not going to bug you to do it. Okay? Thanks for being a part of the podcast. Please tell your friends, your neighbors, your relatives, acquaintances, people you bump into on the street. Ask them to listen to Talking Real Money. And if you really like what you hear, go over to Apple Podcasts and leave a review. And by the way, you want to listen to Saturday's show because we got a review. We got a review that we're going to, we're going to address. It was not a good review. So we're going to talk about it, and we hope you will chime in, because remember, on Saturdays, you can call us live between 3 and 5 Eastern or noon to 2 Pacific time at that same number, 855-935-TALK. Take good care. We'll talk at you soon. I'm Don McDonald, hanging out, talking real money.
Talking real money. We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. Are we done now?